In this video, we're going to look at developments in the bond market, look at some of the key drivers. Just firstly, turning our attention to the sell-off that we've seen in bond markets, obviously from around about 1.9 or a little bit under up to 2.7. From a technical perspective, it might appear to be very close to oversold at the present time. But what does this bond sell-off look like compared to previous bond market sell-offs? So I'm just looking at those that have occurred since RBA independence. So we're looking at 94, 98, 09, 13, and the most recent one. This is in basis points terms, and obviously pales into comparison to the 1994, where the market rose, well, yields rose some 400 basis points. But at around about 90 basis points, this is pretty much in line with the other three major sell-offs. Typically, they've lasted somewhere from 210 days out to as much as 420 days, as we can see here. So it's very similar to previous sell-offs, bar the 1994 one. A lot of the focus around the sell-off in bond markets has really occurred since the surprise victory of Trump in the US presidential election, and the talk around fiscal policy, an increased reliance on fiscal policy. But if we look at the sort of fundamental backdrop, we can also see that there has been some sort of change afoot since the, say, June quarter of this year. What we're looking at here is our measure of G4 growth momentum. So that's the big three developed plus China. And we're looking at momentum, so most recent readings compared to sort of a moving 12-month average. So that's the red line. You can see there it probably troughed in the early part of this year and is ever so slightly be turning up. Now, the red bar is the annual industrial production growth rate. The blue line represents the G4 growth momentum series. So in the early part of this year, it went positive, as you can see, and really we hadn't seen these sorts of readings since 2013, 2014, and that coincided, that period of sort of flat to negative momentum coincided, of course, with that slide in global industrial production growth from around about 3.5 to basically flat. It's now around about 1.5. So the pickup in growth momentum is a sort of a positive development generally, but not necessarily for bond markets. If we then look at the relationship between, say, the bond yield and momentum, I'm just looking at it here. So we're using the US 10-year here. We're looking at 6-month change on the left-hand scale, and the red line is that same measure of now of G4 growth momentum. So there it is in positive territory on the right-hand scale. Really the first time for about a year and a half that we've seen it this consistent. So that, this relationship is generally held over a long period of time. Of course, there are periods where it doesn't, and two recent periods where it hasn't really held together all that well was during 2014-15, where you saw treasuries rise while momentum was still negative, and then treasuries declining despite the pickup in momentum from the early part of this year. So the relationship hasn't been as tight in more recent times, but broadly over a long period of time, it's held up reasonably well. So what if we actually base the strategy around that G4 growth momentum indicator? So what we're looking at here now is the strategy is to a benchmark position is to be 50% in bonds and 50% in cash. The series that we're using, as we're just talking about, is G4 growth momentum, and I'm interested in periods where that series, as we talked about, is above zero and rising. If it's below zero and rising, above zero and falling, and below zero and falling. And we have different actions or positions to put in place depending on the position in the cycle. So the most bullish phase for bonds typically is a period where growth momentum is below zero and falling. And there we go to 60% in bonds, 40% cash. And then the mirror image of that is when G4 growth momentum is above zero and rising, and that's the period that we're in at the moment. And we've got bonds going to 40%, and then those periods in the middle, which are not as really strong positions to be to be taking on. So if they're the position, actually we'll just change this one to 45. So we're just now looking at the performance of that strategy. So starting in early 1991, what it's doing is undertaking those trades, and the two lines showing here is the performance of the strategy series is light blue, and the benchmark is the red line. So the strategy annualized return from following this such a strategy and allowing for a 1 month release lag in this particular indicator has it returning about 6.3 against 6.16, so a marginal outperformance of the strategy. If we look at the chart relative position, so this shows the incremental performance over time. It tends to go in waves, but it's generally been pretty solid. As I mentioned, though, however, in more recent times, it hasn't worked nearly as well. In fact, it's detracted from value since about 2014. You can see there over that period where bond markets, the direction of bond yields was diverging from the G4 growth momentum indicator. That will happen from time to time, and certainly has been the case in the last, say, 12 to 18 months. If we look at 3-year rolling relative returns, you can also see these are relative returns over here. So 0.16 has been about the average over the period, but it's also gone in waves. Over most recent 3 years, the strategy has added basically nothing. But nevertheless, a reasonable indicator. So now I want to turn finally, and getting away from the sort of short-term cyclical moves in the economy and the impact on bond yields, look at a medium sort of longer-term driver of the bond market. And one of the relationships we look at there is just the nominal GDP growth, but in particular the trend rate of growth for nominal GDP. So that's the red line. The blue line is the actual bond yield. The gold is the actual annual nominal GDP growth. So we have actually seen in recent times a pickup in nominal GDP growth. So that's picking up that sort of short-term cycle in the Australian context. Bonds have tended to follow the broad movements in trend nominal GDP growth, albeit with a little bit of a lag. As you can see here, during the 1960s up until about 1980, trend growth had started to already slow around about the late 70s, very early 80s, but bonds here certainly didn't really peak till a little bit later. And we're always sort of playing catch up to the downturn in nominal GDP growth rates. And then, of course, during the early part of the 2000s and up until the GFC, we had a trend rise in nominal GDP growth, supported, of course, by the mining boom. And bond yields probably didn't go as high as one may have expected, but nevertheless, we're on a sort of a bit of an incline. And then, of course, in the most recent sort of 6 to 7 years, we've seen a trend decline in nominal GDP growth. So that is a key sort of backdrop, I think, for bond markets, and it's probably one of the reasons why you might not be overly negative. However, if we look at more recent growth rates and incorporate forecasts, and the forecast I'm using now is if nominal GDP growth returned to a 4% rate, as we can see here in the gold line there, what happens to our trend nominal GDP growth? Well, basically it stops declining, and so that potentially removes one of the key drivers downwards of bond yields, but not necessarily suggestive of a big upside in bond yields from where we are at the moment. Thank you.